So I'm getting ready to buy more gold. I'm only 2.5%, 3% long gold right now. But I think towards the end of the year, you're going to see some scary reports from the BEA, LS, and you're going to want to say to yourself, and the Census Bureau, you're going to want to say to yourself, economy's really slowing here. I'm going to buy some protection because I know the Fed isn't going to raise interest rates very far. Nominal rates aren't going anywhere near where they were prior to COVID. And the economy is about to falter. So the competing interest rate on the US dollar is going to go down. And you want to hold gold because in real terms, interest rates will be falling.
Joining us today on Wall Street Silver is a special guest, Michael Pento, who is the president and founder of Pento Portfolio Strategies. Thank you so much for joining us today, Michael.
My pleasure to be with you, gentlemen.
Awesome. So you are no longer allowed on CNBC, and you've been canceled from that network. Can you explain what happened, Michael?
Well, after years of doing the right thing, I finally got rewarded by getting kicked off the Main Street financial media. My postulate here is that I once called the Federal Reserve serial counterfeiters. So I called it, instead of quantitative easing, I called it quantitative counterfeiting. So maybe they got a phone call from somebody who said, "Hey, we don't like this guy. We don't need that kind of publicity." So maybe that's what happened. Or maybe they just don't like me. I have no idea. I used to be on twice a week for years. Mm-hmm. They needed some buffoon to stand up and tell them why the housing market was going to collapse. So my friend Larry Kudlow, who is no buffoon, he's a very honorable gentleman. He had me on twice a week. They used to deride me and make me look like an idiot as best they could, especially the guests. But I turned out being correct. More importantly, telling people what to do about the recession and the collapse of the real estate market. It wasn't just good enough to know that the real estate market was going to collapse and it would engender a recession. You had to know what to own. Mm-hmm. And if your prescription was, hey, let's just buy a bunch of gold, that was good after the reflation started, but not during August, September, October, November of 2000.
So where do you think we are at this stage of the game with the latest buzzwords are tapering versus a lot of people in our community think it's all a bunch of BS and that there's zero chance in hell that he can taper. What do you think?
Listen, I manage money for a living. So I could be sensationalistic and say things like the Fed will never taper, the Fed will never raise interest rates. I have to be right every day. That's my goal, be right every day. So I believe the Fed has disaggregated tapering from tightening interest rates. Two different things. Mm-hmm. They are going to taper because they're in the process of doing over $1 trillion per night in overnight reverse repos. Mm-hmm. The banks are flooded with cash. They don't know what to do with it. They don't want it anymore. There's all kinds of Basel regulations to hold capital against this money that they don't want, these reserves. So they park it at the Federal Reserve, park the reserves, making 0.05%, whatever it is, almost nothing. But it's better than getting it off their balance. They want it off their balance sheet. So they're engaged in these reverse repos. Listen, the Fed also understands that they've overshot their inflation goal by double. I mean, remember they couldn't get to 2% and now it's 5%? Well, they're worried about that. Every single member of the FOMC, almost without exception, says, we are going to taper our unprecedented and disruptive $1.44 trillion a year quantitative counterfeiting program. That's what they're going to do. And then when they're done with that, then they are going to go and see if they can raise interest rates. Now, here's where I'll probably agree with you, gentlemen, and your audience. I don't think they ever get there. You know, the Fed funds rate went to 5.25% back in 2008, and the wheels fell off the economy, correct? Okay, then we got to 2.5 before COVID, and then we were already lowering our interest rates going into COVID. Into 2020, they had to lower rates 3 times. It had nothing to do with the Wuhan virus, nothing to do with any kind of pathogen. It had to do with the fact that we have so much debt outstanding. Asset bubbles are so inflated that you just can't raise interest rates back to 6% where they were in the year 2000. 6, 5.25, 2.5, 1.75, and now maybe less than 1. So the honest answer is the Fed is very desirous to stop the inflation that they created. They're going to be tightening monetary policy. In other words, they are going to be drawing down QE right into the teeth of the biggest fiscal cliff the world has ever seen.
Are you referring to $3 trillion annual deficits? It's like, who's going to fund the deficit if the Fed's not buying?
I'm referring to the $6 trillion of bread and circuses that was dumped on consumers' heads between March of 2020 and March of 2021. That's exactly what I'm referring to.
Yeah.
$50,000 per US family of stimulus checks and enhanced unemployment and mortgage forbearance and PPP grants, loans, grants, everything. This is all coming to an end. Even the child tax credit ends.
A pre-refund.
We're going to go from showering the nation with trillions upon trillions of dollars of debt. 4 trillion of the 6 was monetized by the Federal Reserve to almost zero. No more QE. Maybe you get a few $100 billion, so 25% of GDP to 2% of GDP. That is not anything we have ever seen in this nation, and it's anything but growth inspiring.
Yeah. Isn't that like a tremendous catalyst for some serious deflation?
Yes, oh, absolutely. In fact, I just wrote a piece. I just put a piece out today called "The Great Deflation of 2022." Right now we have very high rates of inflation, CPI, PPI, or PCE, blah blah blah. The way the Fed measures it, inflation is very hot. I think that we are in a period of disinflation towards the end of the year. And in other words, inflation will still be growing, just a second derivative reduction. So instead of 6% inflation, we'll have something like 3. But then you hit 2022, especially the second quarter of 2022, when the base effects kick in, and you might see out and out deflation, a stock market crash, and an economic meltdown. Before the Fed says, "Oh boy, maybe we shouldn't end this taper. Maybe this is, maybe we're not ready to stop printing all this money." Isn't that sad? What a sad comment that we can't have the United States of America, one of the bastions of freedom and markets. You can't have an economy function without massive and perpetual QE and fiscal support. This is just scary.
So the eviction moratorium is sort of the first one that's going to hit. The student loan one's been pushed out another 6 months. And I think the student loan one will be pushed out till 2023 in an election year. But the eviction moratorium seems to be the biggest near-term thing to hit consumers, don't you think?
Well, it's one of them, but how about September 6th when there's all states end enhanced unemployment?
Yeah.
How about the fact that there's no more go to your mailbox or open up your bank? This was modern monetary theory. You just had $1,400 checks show up to every member of your household multiple times, 3 times.
Yeah.
They had thousands of dollars sent to every person in your family. I didn't get any. I think the cutoff was 150,000 or 200,000. But most Americans make way less than that. The median income is something like $60,000 or something like that ballpark. So most Americans received multiple thousands of dollars per member of the household, along with the fact, oh, by the way, you don't have to pay your mortgage.
Yeah.
So of course, all this ends in 22. How could you possibly comp? This is the biggest growth rate we've seen since like World War II. And then you're going to lap that next year, and you're not going to tell me you're going to have negative growth. You're going to have inflation and recession next year. And who is talking about that? Who is preparing you for that?
It could start showing up way faster than that in the monthly numbers as soon as, you know, October, November, don't you think?
Possibly, but
Yeah, but I get your year over year, but I think that people are going to see that coming way before
yes,
next year.
Yeah, well, that's why my portfolio is hedged for we were long inflation for most of 2020, from April 2020 till early 2021. But now we've changed towards get this, bond and bond proxies, utilities, duration bonds, the dollar. Where do you hear that from? I mean, listen, I'm an Austrian economist. I hate the U.S. dollar long term. I think bonds are a disaster. I mean, your real return on a bond is profoundly negative, and it's going to get even worse. But listen, like I said, what's going to work now? Guess what? Duration, zero coupon bonds have been working.
Okay, so
the dollar is up on the year. EEM, emerging markets, are unchanged on the year.
So that sounds like you're projecting not so good things for gold and silver now, short term, but longer term, yes.
No, wrong.
Okay.
I take
yeah,
this.
Yeah.
I actually don't think most of Wall Street understands what makes gold. First of all, gold is not silver. Gold is money. Silver has some base metal component, industrial metal components to it. So I don't conflate them. They're totally different. And a gold miner is different than a U. Okay, so it's totally different. So I think that you have to understand what drives gold. Gold is honest, real, genuine money, and it competes with the greenback. It competes with U.S. dollar. If you're measuring it against dollars, it competes with all fiat currencies, but let's measure it against the U.S. dollar. So when the U.S. dollar, when the interest rate on U.S. dollars is going up in nominal terms, and in real rates it's rising too, then you want to avoid gold like the plague. But I think once this taper gets going, we only have one other back test for this. Once the taper was going in earnest in 2013-14, gold bottomed then. Gold bottomed because the economy began to slow, and a slowing economy brings down long-term bonds. And what happens when the economy slows is that the Fed gets ready to print money, which creates inflation. They cap interest rates in a nominal sense. And they create inflation, which causes the real interest rates to fall, which drives gold higher. So I'm getting ready to buy more gold. I'm only 2.5%, 3% long gold right now. But I think towards the end of the year, you're going to see some scary reports from the BEA, LS, and you're going to want to say to yourself, and the Census Bureau, you're going to want to say to yourself, economy's really slowing here. I'm going to buy some protection because I know the Fed isn't going to raise interest rates very far. Nominal rates aren't going anywhere near where they were prior to COVID. And the economy is about to falter. So the competing interest rate on the US dollar is going to go down. And you want to hold gold because in real terms, interest rates will be falling.
What's your outlook on the dollar? I mean, you're bullish now. I mean, surely you can't be bullish long term on it.
Well, what happens? So let's look at it. Let's look globally. Globally, this is the context of how the dollar behaves. The dollar is one of the most shorted currencies in the world. People borrow dollars, right? Sell them and buy things overseas that have higher yielding bonds and higher offered dividend payments. So when you have a global crisis, what occurs is there's a reversal of that dollar carry trade. People have to sell their foreign denominated assets and close out that short, and they buy dollars. I think that's going to be a salient issue going into Q2 of 2022. That doesn't mean that gold can't rise. You know, gold and the dollar can and have and probably will rise concurrently next year because it's real interest rates that matter more than the dollar. And then after that, once the Fed assents to the notion that they cannot raise interest rates and real interest rates begin to fall, that's when the dollar will really take a beating after the global, but that's ex post the global chaos.
So, Michael, what are you going to be monitoring to determine when it's time to switch from a disinflationary position to an inflationary one?
Well, first you have inflation now. We're headed for disinflation. Then we're going to go to deflation, which is sector one of my IDEC strategy, and then you're going to go to inflation. But we might just go from inflation right to stagflation and then tractable inflation. We might just, we might not just pass go and collect 200. We might just go right to stagflation and intractable inflation, because if the market becomes aware that, hey, wait a second, Mr. Federal Reserve, you've lost complete control of the currency. They control the currency, not the Treasury. The Fed controls the currency. You can't ever drain your balance sheet. You can't ever not let it grow. You can't ever raise interest rates. So what happens then? I mean, you're going to lose control of inflation very quickly.
Yeah.
And you have rapidly rising inflation, which, by the way, is a killer to growth. Inflation and growth don't always go hand in hand. I mean, if that's the case, then Hungary post World War II was, an example of, a robust economy, or Zimbabwe or Argentina. I mean, this is Venezuela. You can't have you can't hollow out your middle class and engender growth. You just can't. So I think we go from inflation, disinflation, which we're on position now, deflation, and then we can go right to intractable stagflation.
In the late 70s, Paul Volcker, his solution was jack up short-term rates to 20%. And obviously that seems ridiculously impossible now. I mean, back then he had 30% debt to GDP. Now we're approaching 140, 150% debt to GDP. What's the ultimate end game here? In order to get ahead of inflation, it's my understanding, based on everything I've learned, you got to get short-term rates higher than the inflation rate. And ShadowStat says inflation's over 10% right now. But so how do they kill inflation this time? Can they, or it's just?
Well, they have to make a choice.
They got to kill the economy to kill it.
They got to make a choice. I mean, you can't. This is the trenchant difference between now and what's happened before. I mean, you think about 2000, deflation was the problem after the burst of the NASDAQ bubble. So they came up with more ways to pump up money into the economy. And when the real estate market collapsed, deflation ensued, and we had to come up with ways to, pump up the economy. But all those instances I just mentioned, interest rates were much higher than they are now today.
Yeah.
What are you going to do now if we have another chaotic crumble in the credit markets, which I see happening for sure? If you look at outstanding credit market debt, it's twice as high as it was in 2013 during the original taper tantrum. Twice as high.
Yeah.
And the national debt is twice as high, almost twice as high too. So what are they going to do this time around? I really don't know that. I think they have to choose between, do we want to hyperinflate the middle class out of existence to protect Wall Street? Or do we, go the Volcker route and just kill the economy, but, at least plant the seeds for a real and viable economy on the other end of this, where, Wall Street isn't trading. I didn't mention this. In the last taper tantrum, I love it when people say, this taper tantrum was already priced in and it's just going to be like last time, well, the total value of equities relative to GDP, which is the only honest or the most honest measurement of stock valuations, it's 2 times where it was in 2013. It's over 200% of the underlying economy. So don't tell me that we're going to have a seamless exit out of the quantitative easing program. I don't believe it. So I think they have to choose. What do you want to do? Do you want to save Wall Street, or do you want to set the seeds and the situation will be for a viable, vibrant, and healthy U.S. economy long term? But you got to kill the economy first to do it. You've got to say, well, I have to raise interest rates to, I think Jim said 10%. Maybe not that high, but you have to dramatically raise interest rates to get home prices to crater. right?
Yeah.
Well, you get home prices to crater, so the first-time home buyer can get to afford a house. But private equity Powell, that's where he's from, and the Fed's charter is put in place to protect banks. What will you do to the U.S. banking system if you crater real estate and the shadow banking system and the repo market and the CLO market?
Yeah, it's not just raising rates. Can you imagine all the derivatives on all that low interest debt that just implodes with a 5%? No, all that square. I don't even understand it all. All I know is what I learned from the movie The Big Short. But all that squared, cubed, you probably know it inside and out. But does all that stuff blow up at 4%, 5%? Someone's a counterparty that's going to get screwed on one side of that trade, right?
I don't think it would be anywhere near 4 or 5% to engender the next credit card. Like I said, you might not even be able to end QE before you have an accident in the stock market. The stock market and the credit markets are Siamese twins. So if you have a big accident in the stock market, you're gonna mortally injure credit markets. Triple C debt, junk bonds are at record outstanding junk bonds. The yield is the lowest spread to treasuries ever. The nominal yield is the lowest ever. So you're going to injure the credit market. All these swaps are going to go belly up. And you talk about derivatives. Swap is a derivative, but you talk about a lot of problems on Main Street and Wall Street at the same time. And then the Fed has to ask themselves a question: what do I do? Do I bail out Main Street? Or do I bail out Wall Street? Either way, Lee, short term, you cannot avoid the chaos that's going to come.
Yeah. Speaking of chaos in Wall Street, I mean, are you short the equity markets now, or?
Not one short, short, because I created a model. I mean, my model was, I have a lot of money in my own strategy. I realized early on that I have to understand, well, I would like to make some money, but you can't put your money in the bank. Because what is investing after all? It's a real after-tax return. Tell me, where are you getting a real after-tax return? You have to go all the way out to the 30-year treasury. And even then, you're not getting a real after-tax return. So what do? You go way out on the risk curve. Well, if I'm going to go way out on the risk curve, which I am, I have to have some comfort to sleep at night. So I created this model, 10 components for inflation, deflation, 10 for growth and recession, that lets me know, it's like an early warning sign. When I see problems in the credit market, when I see early signs of a recession, so I can get the heck out of harm's way, out and short. Because Lee, this reconciliation of stock prices is going to be epic in nature. Yeah. I think you can go down 50+%. And I hasten to add this to you, is that instead of just saying, well, and I get this all the time from other people that interview me, well, wouldn't the Fed just come back in and save the stock market? Well, I think they might try, but you have that inflation problem again. You have that credibility problem again with the US Treasury market and the dollar. But more than that, who says you could just come in, a central bank could come in and save the stock market? Is that what happened in China in 2007? Is that what happened in Japan in 1989? Well, we're at those great inflection points. We're Japan, 1989. We're that overvalued, and they're still down 30%. Yeah. Does everybody know? Is everybody aware of that? I say it almost on all my interviews. We're down 30% from what happened 30 years ago in Japan, which has the most maniac central bank. Okay, the Bank of Japan is more maniacal than the Fed. Okay. As far as what their quantitative easing program, they own almost every JGB that's ever issued from, they
own 20 or 30% of the stock market too, don't they?
45%.
Yeah, and it's still, so even if the central bank, the Japanese central bank, or in our case, the Fed, were to buy 30% of the equities, there's so much selling that everyone's it's a put on the Fed at that point. All the bonds, all the stocks, if they're the buyer of last resort, they'll own everything, and it still won't elevate prices back to current levels.
It might not. I mean, we have a record amount of margin debt outstanding, and as a percentage of GDP, it's a record amount of margin debt. So when the margin calls come in, when the credit crisis starts to ensue, you're going to have ETF redemptions, and you're going to have lock limit down days. All these things are most likely. I mean, again, I'm predicting it. I'm saying it's likely to happen, but you can't just invest that way. Right now, I have, like I said, Lee asked me, I have no shorts, zero, no shorts. My hedges right now are a little bit of gold and duration bonds.
You think gold becomes the fear trade at that point? It drops in the initial drop. Gold and silver probably drop with it because of margin calls and people need cash. But then once the fear trade kicks in, gold and silver take off like a rocket, probably.
So right. This is the back test. This is what's going to happen. Happened in 2000, happened in 2008, happened in 2018, 2019, 2020. Every time you have a global crisis bubbling up, remember the repo crisis of 2019. It's always the same thing. It's people lunge or lurch towards cash. They need liquidity. You said it perfectly, Jim. So what do you own in that short duration of illiquidity? You own US dollars, short-term treasuries, cash, and you short the stock market. Those are, I call them the four horsemen of the apocalypse. Those are the only four things that work because all of the correlations go to one. I don't care if you own large cap, small cap, defensive, cyclicals, all that garbage, foreign stocks, none of it matters when you go into a liquidity crisis. It's just, this is it. It's a you and a cry. I need dollars. And that's the only thing that works, dollars. But then the whole thing reverses. Then the dollars toast, and then once you reliquify the banking system, however long that takes, then gold takes off like a rocket ship.
Okay. Do you do targets? I know you got to go. We're at your time limit. Do you have an upper end target for gold that you got this?
Well, I mean, listen, it's a fool's errand. I think gold should be $6,000. I think gold should be $6,000 an ounce. I mean, heck, if you can get Bitcoin, or can I say coin onto your?
Yeah, sure.
Of course you can.
I don't.
It's cable. It's cable, man.
You're going to get some haters in our audience, but it's okay.
Oh, listen. Everybody hates me. I don't care.
No.
So
we love you, Michael.
Thank you. So if that can go to $60,000 a unit, a $60,000 a unit, then why in the world can't gold go to $6,000? If you look at just a calculation of money supply analysis of gold. But that doesn't help you. Like I said, that doesn't help you. When you want to be, when gold hits a bull market, it can go over 6,000 because it gets more expensive. And in a gold bear market, it can be way under and get even cheaper. So I don't buy things because they're cheap. I don't buy things because they're expensive. I buy things when the macroeconomic cycle matches. And we are not there yet, but we're getting close, getting very close. In fact, I would tell you, if I had a guess, and I'm not being held to that because I run the model every day, it has daily functions, weekly functions, monthly functions, and quarterly functions in the model components. And I run it every day. So I think by Q2 of 2022, I would be very surprised if I wasn't much longer of gold.
If you're wrong, don't worry. I'll delete this video off YouTube.
No
one will ever see the evidence.
Unlike the rest of the carnival barkers on CNBS, hold me accountable, please. Okay. I love to be held accountable because if I'm wrong, I want to know why I was wrong. I'll make the changes to my thinking so I don't make future mistakes. Because at the end of the day, what are we here for? We're here for, I'm not talking about existentially. I mean, we're here to be the best person God made you to be.
Why are we here? Yeah.
Why are we here? But why I'm in the position that I hold is to make money for my clients. And that could be in any asset class or any sector or any style factor that fits.
Well, thank you very much for joining. I know we're over your time limit. You told us you have to go after this time, but we really appreciate you giving us a half hour of your time. And we'd love to talk to you again in 2 or 3 months as the market develops this year.
Thank you very much, Michael.
Looking forward to that, Jim and Lee. Thank you.